Good evening, ladies and gentlemen. Thank you so much for giving us your time this evening and for being a part of our event. So incidentally, we've started a new series at CNBC TV 18, which we call The Investing Edge. Our partners in this are Anand Rathi Private Wealth Management, and with me is Feroze Azeez. He's the Deputy CEO of Anand Rathi Private Wealth Management, and incidentally, he is also one of the youngest wealth managers in the country. Feroze has been with Anand Rathi for a long time now, and he's been a friend to CNBC TV 18 as well for the good part of a decade, perhaps longer, if I'm mistaken. And at Anand Rathi, Feroze manages their treasury, which is about 3,000 odd crores. He himself is one of the largest customers of Anand Rathi himself. As well, he personally manages a portfolio of about 1,200 odd crores, give or take a few. Okay, and besides that, over the last 6 years, Anand Rathi has seen a decent growth, actually, if you could call it that. So with Feroze at the helm, he has managed to take the assets that Anand Rathi was managing from about, 6,000 odd crores, now to about 20,000 odd crores. So before we begin, I want to invite Feroze to actually talk to us a little bit about the investing landscape and what he's specifically doing at Anand Rathi and how they've managed to help investors over the years. Feroze.
I think wealth management as a specific job to do, we think that every wealth manager has to learn from others and extrapolate it to a larger audience. So what do I mean by that? Because your profession involves interacting with a lot of people with respect to specific aspects of finance, you realize that some people are doing good things. You have to make sure that those good things are transmitted to a larger audience. And if there's some things which people are going wrong in, if that can be actually shared with the rest of the group, then most of us will not be rediscovering the same mistakes. So in that journey, we have realized that there are two ways of managing money. There are two distinctly different ways. One, which is what the companies and treasuries use. The other, which individuals end up using. If these two methods have to be compared in terms of sharpness, focus, and profitability, the one which the treasuries end up using are far more sharper and they're far more profitable, but lesser popular amongst individuals. The first method, which is the more popular one, is only focusing or always starting with opinions. If this describes your wealth management journey so far, then you should also contemplate, at least considering, another method which says opinions are not the end all and be all of it. Let's start with objectives. So what are the objectives one should have? That's the most important question you have to ask yourself. So objective, strategy, implement the strategy, then check yourself on a regular basis whether you're going towards your objective or drifting away from it. So what are the objectives, right? The objective one is all about rupees, money, right? Objective one is to beat inflation. Mehengai ko mat dena. 1% of India is what we all represent. So the inflation number for you, which we computed, was 12.13%. So if this is the kind of pressure your money is going through, and you might assume that 3% is the inflation, then it might be a wrong objective to set yourself. So you have to be 12. That's objective 1A. 1B. Objective 1B. Keep a target. Most people don't have a target. Right? In treasury, there is a target. Every time there is a target, there's a quarterly checking of the target. In wealth management of individuals, there's no target. So what do you mean by that? First, draw up your entire balance sheet. मेरे पास पैसे कितने हैं? PF ऐड कीजिए, ESOP ऐड कीजिए, insurance policies, mutual funds, everything other than the house you live in is called your balance sheet. So having a target is critical. In India, your target should be 15% per annum consistent growth on all your balance sheet. Objective 1C is to focus on taxation. See, there are 1,000 sections in income tax, could be. but there are 5 very, very important investment sections which will make sure that you pay optimal tax. So tax should never be greater than, or if it is greater than 12% on investing, that means there is scope for improvement.
Okay, so investing is more of a scientific process and not entirely emotional. So we'll get to asset allocation, risk management in a bit. The other thing I want to talk about is transmission. Would there be other better methods? Is will the best?
Will, I think, is mandatory, but at least for myself and a few of my very close clients whom I manage personally, will is going to only be used for 20% of their money, 15%. 85% is going to be used using another vehicle, which is called an irrevocable, discretionary, private family trust. What is the khasiyat? Because will requires probate. Will को dismantle करने के लिए order चाहिए होगा. This vehicle is so good that the day I die, next day it will be as smoothly managed within a day. And the transmission loss is negligible using a irrevocable, discretionary, private family trust.
Now that we've spoken about transmission, the other problem that remains is encroachment. What's the best way around it? Are there several methods to it? Is there just the one?
There are 3 methods. Method 1 is PF, right? Employee Provident Fund and Public Provident Fund are not attachable. The second method is called Married Woman Property Act, MWPA. Every insurance policy you buy, you can choose to buy it under an act which is called the Married Woman Property Act. MWPA is a method, which is what is, the third method is a copy of MWPA, but you don't get the insurance company to make it, you make it yourself so that you have the freedom to buy a car in that vehicle, a house in the vehicle, a mutual fund in the vehicle, an FD in the vehicle. You can buy whatever so you choose to. If you delegate it to an insurance company, he will only help you buy an insurance policy. So these are the 3.
Okay, fair enough. Now let's talk about risk management, right? Because you may have money, you may have newer avenues to invest in, but you don't want to take excessive risk with it, right? So what is low risk? How do you achieve that 15% that you spoke about with low risk?
To manage anything, you have to measure it. To measure it, it's not so difficult. Right? Don't just measure the return, measure the risk. So first you measure it. The best method to measure is something called standard deviation. If you have bought an FD, if you have been promised 8, is it likely that you will get 8.5 or 7.5? You will get exactly 8, right? Because it's a constant. It's a constant. When I said 15, is it a constant? No, it's a variable. Standard deviation helps me understand the variability in the variable. We do a strategy which gives us 15 as the return expectation and 7.7 as the swing. Kitna swing ho sakta hai, right? So point 1, what does standard deviation do for me? It helps me measure risk. It helps me understand the variability of the variable. Very important to understand the variability. Of course, if you're attempting to measure risk first time today, in 2-3 years, there will be so much comfort, but begin the journey of measuring risk. So 8 standard deviation means that 15 plus 8, 15 minus 8. Jule ki tarah, 15 plus 8, 15 minus 8. That is called swing 1. That is called swing 1. You have to also calculate swing 2. If you have to understand your risk, you have to calculate swing 2. 15 plus 8 plus 8, 2 times 8. 15 minus 8 minus 8. So you got 2 swings. 15 bola isne और 8 की swing, फिर 16 की swing. So this 98% of the times, you will always be in this range.
Okay, so let's get to some of the other things and then we can get to the audience questions. You know, over the many years, I've heard you refer to structured products, right? How has that been in terms of, how successfully have you managed to use it for your clients? And why this love for structured products? I mean, what is so good about it?
See, before we get to structured products, we need to know the context. Most portfolios, the biggest learning I had a few years back, and I said, what's the mistake I did when I was advising to clients, is having a belief that tum sahi jaoge hi jaoge, jo ki nahi hoga, right? You generally, because you're saying this to so many people, you start believing that you will always go right. But that's not humanly possible. So always create a portfolio with a plan A and a plan B. What do you mean by plan B? See, Modi government has come, India's growth story, consumption story is so enormous. India's tax collection possibility is very, very high, in my opinion. But what if, like the last 5 years, Nifty gave return less than an FD, less than debt? How does my client still make those 13, 14, 15%? Structure product actually tells you when markets disappoint, markets do 3% a year, 4% a year, or 5% a year. How can I make 17%? So structure product tells you that I will give you no more than 17. It caps your return. Biggest disadvantage of a structure product is it caps your return, but tells you that if market gave you 5, I will give you 17. If market gave you 30 per year, I will still give you only 17. So when the markets do well, my mutual funds do well. When the market disappoints, structure product comes in and gives you that 17%.
The one question that I'm sure a lot of people now want answered is that how do they finally go and choose an advisor?
So I did a study, okay, which is a better strategy? Have multiple advisors or sole advisors? It's an important study. If multiple advisors is helping me generate more return at lower risk, then I would say definitely go with multiple. But you should ideally, the data clearly throws up that the returns of a sole advisor are better than multiple advisor portfolios, whoever that advisor be. If you want to choose multiple advisors, don't choose them at a point in time. It's not that you start with sole advisor, right? You interview them in the process of 3 years, 4 years, 5 years, and then come to one advisor. I recommend people to come to one advisor. At least in 4-5 years of journey of wealth management, if you've not come to one advisor, that means you can still reflect upon whether I should be, if you want multiple, at least you should have toyed, you should have at least contemplated in your mind whether kya mujhe multiple chahiye. It should be a strategy, because multiple advisors have not created more return, but it will take 4-5 years to be able to judge an advisor. But at a point in time, there has to be a full stop to having people pull you from all directions, because objective cannot be owned by 4 people. Then the second part of the question is, how do you choose? But if you have to choose, you have to be clear, what am I looking for? You should look for capability, trust, and commitment. These are the 3 things. Everything else is a subset of this.
Currently, I have a portfolio which is a mix of mutual fund and structured products. But going forward, being a retired person, would like to invest in a risk-free or less risk instrument, which also gives me monthly or quarterly returns. So any variant of structured product or similar risk-free asset in which I can invest?
Generally, you should not look at risk at constituents level, ideally. You should look at it as a full portfolio only. Risk of one constituent should ideally not be looked at, in my opinion. Because अगर आपने पूरे portfolio पे risk manage करनी है ना, पूरी जिम्मे आपकी पूरे पैसे आप ही के हैं, right? So as long as if you're not happy with 7 standard deviation, okay, which is what your portfolio might throw up. If you are not happy with 7, you should tell your advisor, bring down the standard deviation to 5. Now, to give just one piece of tip, I would not say advice, is you can definitely buy debt funds and do SWP. The risk is very low. It's going to still be significantly better than a fixed deposit for a person who has a larger portfolio because he would be in the highest tax bracket.
My question is, in the Indian context, how relevant is precious metals and works of art?
Gold is not an asset. It's a currency, in my opinion, which is being used as an asset. Anything which stores value is currency. Anything which creates value is an asset. अगर आपको डॉलर accumulate करना है, आपको बच्चों की पढ़ाई बाहर करनी है, आपको medical expense बाहर के लिए accumulate करना है, तो gold has a place in the portfolio, not because of gold, because it's the easiest way to access dollar and store dollar. So art is something I would say that till you don't understand the asset, don't buy that asset. If you have an inclination towards art and if you understand it, at least most of your advisors will not understand it. And I have done that mistake way back in 2006. I bought a fund, I'll name the fund also, Ocean Art Fund was the fund which I bought for some of my clients. And that resulted in a loss for my clients. It resulted in a principle to never buy anything for a client which I don't understand fully.
You said something about LEAP. Would you elaborate on it a bit and how it's useful for a common investor?
If I bought a LEAP of a specific kind, it will act as an insurance against huge market corrections or any market corrections of Nifty. अगर market आधी हो जाएगी, Nifty आधी हो जाएगी, तो NSE के द्वारा, NSE के माध्यम से आपको compensation मिल जाएगा.
How would you think the real estate is going to perform?
So real estate has this habit of not falling. Okay, what? Because people close their eyes and say that 4 साल बाद मैं बेच लूंगा. Right? So people, it goes through time corrections. Only builders reduce price. Point 2, real estate has this good advantage that nobody comes and tells you the price every day. So you end up holding for 10-15 years. Every day if some broker came and gave me a advance check saying that आज 4 करोड़ दूंगा, आज 3.5 करोड़ दूंगा, एक ना एक दिन मैं बेच देता. The problem with financial instruments is they give you a price every day which can result in an action.
What is the HUF and does it become what you called it as a irrevocable discretional private family fund?
HUF, of course, has largely only one merit. It does not ring fence. It transmits to a certain extent. Only the money which is there in its file. See, now let's assume there is one file which is of the Karta, and then you have the HUF file separate. One big benefit of HUF is the section 80s. You have an extra file to reduce taxes, income tax, not investment tax. It is revocable. It is not attachment free. If there is a liability on the Karta, HUF monies get attached. Point 1. I would never transfer all my money from my name to my HUF name. Right? So, an irrevocable discretionary private trust. I have transferred very, very large quantums of money there. And it is growing there because, see, in that trust, family trust, I only manage it. Matlab, it's no external, it's trust, don't go with the word which is a Bari Barkam trust word. It's a simple 4-page, 5-page document registered and a separate bank account, separate PAN card. That allows me to transmit a large portion. 80% of my money can go there. As I progress in life, 80-90% will be inside that. And I have given away the money, but I still have the discretion. Like the Raymond case, where you gift it to your child, then you don't have a control on that money.
At 30, if I'm a financially dependent person and I want to become financially independent in the next 15 or 20 years, how much percentage of my income do I need to be saving? and investing? And is this an age to be safe with my investments? Like you said, 65-35. So at the age of 30, would you still stick by the 65-35 ratio?
See, the country has lived in a regime of 60-70% tax. So assume that there is so much more taxation and put an investment tax of 30% of whatever is your disposable income is very critical. If you're saving less than 30%, that means you're living beyond your means. And I think discretionary spendings have to be cut. And your asset allocation should be 100% equity. Why? Because you have 15 years. It is not technically possible for the country of our size and our growth where equity will deliver lesser return than debt. It is not theoretically also possible, right? That in 10-15 years, equity will deliver lesser return. Then if you use better vehicles, then you can, in a 7-8% equity also, you can deliver 14-15 if you use right vehicles.
You mentioned during your conversation about the inheritance tax which may come in. So if you could help elaborate, so if there is a trust which is created now, would that mean those who inherit it would have to pay tax at their end?
See,
and maybe a little more around that. Thank you.
There are three ways to give away your money. Na? One is gift it in your lifetime. I can gift all my money in my lifetime, right? But I don't want to do that because I want to be in control of my money, right? Because even if I gift, I'll gift away 30%, 40%. So one method is gift. Second method is will. The third method, which I'm telling you, is that irrevocable private trust, right? This third method prevents yourself from inheritance tax because when I today make a trust, so step one, make a trust. Step two, make a gift deed. Make a gift deed and fund the trust. So Feroze is gifting away money not to any of these three people, but to the trust where these three people's names are mentioned. Okay? So today what is the gift tax? 0. So under the current 0 gift tax regime, I have got a gift deed made and I have given the money. So the money has left my balance sheet. It has left my balance sheet. So it's got nothing to do with me living or dead because it's left my balance sheet, right? Now I still am in control of the money in spite of it having left my balance sheet. So whenever inheritance tax comes, it will start with a very small amount, 2, 4, 5%. But in a country like India, where the wealth is so skewed, it is very easy to bring in inheritance tax because it will help the vote bank also. So if you use this trust and gift it in your lifetime, it is not a part of your inheritance. And globally, the inheritance tax ranges between 30 to 50%. Whenever inheritance tax comes, gift tax will also be introduced. Otherwise, when you're rushing to the hospital, you can sign and gift everything. Na? So there will be gift tax also introduced, which is not there in India for relatives. Inheritance tax has to be combined with gift tax. That's how the global practice is.